Okay, guys, now I'm a learner, just like you were studying for this exam. I'm not a lecturer, not a teacher, but I can teach, right? So, this is chapter 1, and this is topic 1.1 of Finance 201. So, we're going to be explaining this whole topic PowerPoint thing, and hopefully, I can convince you to understand. So, going on to chapter 1, right? This whole chapter is basically describing the concept of finance. Why the business, uses finance. Right? When you talk about financial management, that's where businesses needs to make financial decisions and everything, right? So, going on, what is finance? So basically, finance is about managing money, right? If you're a business and if you own a business, you need to make sure you have a low expense. You need to make sure the money in your business you invest it in good stuff, right? You get a return. You also need to make sure where do you get money from, sources of funding, right? Because obviously, to buy products in your business, you need the money, right? You need the rands. So you always need money in order to operate your business. So where do you get this money from? So that is all about finance, what we're going to learn just now. So there's two branches of finance. Number one is management finance. So if you picture a person in a large business, they will be doing management finance. They will be looking at all the stuff that's happening in the business and make decisions, right? For example, how much of products to buy, how much of rands each product is. That's like management finance. Investment finance, however, is when you take money and when you put it in something to get more money, to get interest, right? The biggest one is the bank, right? So if you're a person and if you put money in a bank, you're gonna get interest, right? That's how it works. So that's like more of investment finance or shares. You can buy shares. You invest your money to get a return. That's investment finance. Now, financial management links with economics and accounting. Why? Because you need economics and accounting if you want to be a financial manager. So when you're a financial manager, you need to know economics. You need to know what happens when a customer, the demand changes for a product, right? You need to know. Product goes low, less products will be sold. Easy. So we need to know all that, right? Now, decisions, major financial decisions. There's three major financial decisions. So let's own a business, huh? Let's call this business the boom boom business, right? So the boom boom business, there's three major decisions, right? So let's say you open up the boom boom business, right? You need to make sure to invest into something for the long term. Now, what does this mean, right? Long term investment of projects, capital budgeting. Capital budgeting means taking your capital, taking your money in the business and investing it into something. Now, you can either invest it into investments, which is like you buy, let's say, products in a business, you buy new equipment in a business. All that is investments or projects. So you can basically like do a project where you'll basically expand your business more. So all this is capital budgeting. When you have your boom boom business, you want to expand your business next year. If it's doing well, you're gonna make more products in the business. That's investing, taking money and making something out of it for economic benefit. So that's capital budgeting. Now capital structure is this. You got all this business, you want to create another venue, you want to create new equipment, you want your business to get bigger. Problem is, big problem, how do you do all this? You need money. You need money from somewhere to make your investing, to make more products, to make your business bigger. You need the money. Where do we get the money? Capital structure. You can either get your money from two places, right? Debt or equity. So, what do I mean by this? Debt. You, as the boom boom business, you need money. You'll probably go to the bank and want a loan. That's debt. Or you can take money from your own pocket that you have stored. That's equity. Now, the boom boom business, we're assuming it's a small business. But let's say the boom boom business in 10 years' time is a big company, extremely big company, massive organization. Whew. The boom boom business now, when it takes debt, it doesn't have to go to a bank to take debt, right? It can issue something called debentures or bonds. What is that, you might ask? On the JSC, debentures or bonds are basically loans the business gets from people. Okay, so we are owners of the boom boom business, right? We need money. So we go to people who want to give us money, right? So let's say there's a person named Sam. We tell Sam, Sam, listen here, I want R1,000,000, right? And every single year that I have that R1,000,000, before I give you back, I'll give you 10% interest. That's a debenture or bond. So you issue it, right? You'll see in the JSC, debentures is like you will get interest. So when you buy a debenture, you will get the interest from the company. So if you're a company, you will get the full R1,000,000, the loan amount, but you have to pay interest to the person every single year. That's a debenture. It's where companies take borrowed funds from investors, right? But you obviously have to give them interest, see? So that's debt. Or equity. If you're an extremely big business, you can issue shares. If you're a public company, shares, equity. So you can issue shares, for example, 100,000 shares at 2 Rand. That means you're getting 200,000 Rand in your bank account, right? If they ask you which is better, debt or equity financing, hard choice to make, right? Because you have to know, if you issue capital like shares, you're gonna pay each time dividends on those shares. That's going to be very costly. So sometimes it'll be better to actually take debt. For like 2 years, you're paying 10% interest. After that, when you repay the money, it's done. But for taking shares, right, every year, as long as the shareholder is there and has that shares, you're going to pay him dividends every single year. So sometimes it become very costly. Now, what's working capital management? What's working capital? It's your current assets. So your inventory in your bank is working capital. The amount of money you have in the bank is working capital. The amount of um, debtors you have, trade receivables, are your working capital. Working capital is all a current asset. So you see what I mean? Current assets can be quickly converted to cash. If I want 50 Rand now, I can go to my bank and get that 50 Rand. You see, that is what my bank is, a working capital. It's a current asset. I can very quickly get to it within 1 year. Debtors also, although you might think it's hard to get money from them, within 1 year you can get money from them, right? So your working capital management is taking care of the money you have for the year. Basically, paying off expenses using the working capital, right? Also to finance it, to buy inventory, working capital, and sell those inventory. All that relates to working capital management. So what long-term investment should you choose? So this is where you invest, right? The first one, capital budgeting. You'll invest in more buildings, you'll expand your business, you'll come big, constructing your business, making more buildings, getting bigger. That's investing, and we discussed about that. Now, financing decisions. So this is what we learned is capital structure. Yeah. So it can either be debt or equity, right? Now, you can either finance your business with debt or equity in different like ratios, proportions, like 10%, 90%, whatever, right? You choose. Um, how should the firm raise funds for selected investments? Yeah, for example, if you want to buy inventory that's an investment, where do you get the money from? I mean, I highly do not suggest getting a long term loan for buying inventory. I will suggest basically a bank overdraft, something quick. So if you get money from the bank in overdraft, it lets you get more money than what's in your bank account, pay for the inventory, then sell the inventory, make the profit, pay the bank back. Very efficient, very fast. No need to get a big loan and all that stuff. No, inventory is a small thing, right? I need the money, pay for the inventory, sell the inventory, get all the money back and pay my bank. I'm not gonna get all the big long-term loans, all that. Okay. Sources of funding, right? Three major sources of funding now. Retained earning, debt capital, equity capital. I already told you what's debt capital and equity capital. You can issue shares over here. You get money if you're a company. You can issue debt capital like debentures or bonds. I discussed that. You can get money. Also retained earnings. Now accounting students will know what retained earnings are. So you know in your income statement, net profit after tax, the last figure, that's your profit for the year. The profit for the year, you're going to pay out dividends. So you're going to pay, let's say your net profit is 100,000. If you're going to pay 20,000 Rand dividends, your retained earnings will be 80,000. Retained earnings. Another name for earnings is profit. Retained profit. So what is your profit after everything, all your distributions, all your expenses, after all your dividends? That's your retained earnings. Your retained earnings will be 80,000. So the 80,000 will be stored in your business bank account, right? So this will be stored to use it for investing, buying more inventory, doing it. Basically is up to the company's decision what you do. So sources of funding is extremely important. Now let's discuss it. You can get finance from capital markets. Now as soon as you see capital markets, I want you to think about market shares. The same thing. So when you think about capital market, just think about JSC shares, all that, right? So capital market, you can either get issue shares or issue debt. Shares, you can either issue shares. I told you ordinary share, all that stuff. Or you can either issue debts like debentures or bonds. Told you, this is where the business gets a loan from an investor, and you have to pay the investor interest on it, right? So in the capital market, right, think of JSC, simple. You can do two things: issue debt or issue equity. Finance from money markets, very important. Oh, I forgot to discuss this. Very important concept, Joe. 1 second, let me go back. Capital markets is long term. Let me write it so you know, yeah. Very, if they ask you this long term, very, very good thing to do, explain. Everything in capital markets, you issue shares, you issue bonds, debentures, these are all long term, last more than a year. Money markets, however, is short term. So you see how it's the opposite, capital markets versus money markets. So money markets are short term way of getting money. If you want to get money from a bank with a bank overdraft, that's short term. You see what I mean? You pay money bank within a year. You overdraw 100,000. I mean, it won't be so much, but like 50,000. Then you pay back 50,000 within a year. Bank overdraft always short term. That's what you need to know. So that's another way of sourcing money. Another way of sourcing money is creditors. Well, kind of sourcing money. So you know your supplier. So you got Steve over here. He's a supplier. So he supplies you with the stuff, right? So you are a person who sells the stuff, right? So you need to buy the products, sell the products, right? Easy. Supplier. Now, your supplier needs money. You can't go there to your supplier and say, hey, what kind? Oh, I need to buy 100 worth of goods. I don't want to pay you the money. No, the supplier will need the money. But then again, you can do finance from creditors. You can tell the creditor, your supplier, listen here, I'll buy the product from you, right, for my business. But I'll only pay you 30 days time. Creditor, the supplier will say, perfect. That's a finance. Why? You don't need any money to buy those products. You will buy those products, right, without any money. Sell those products, make all the money, then pay your supplier. That's actually such a good way because you do not need money to buy the products, right? So after you sell the products, make your profit, make the money, you can pay your supplier and then keep your profit. That's very efficient. That's source of funding. Finance from creditors. Then your retained income. Same thing I told you, retained income is where you can retain your profits in the business, right? Do not put all your profits in your dividends. Do not pay all your profits away. No, keep your profits in the business secured so you can use it to source for finance. How should short-term assets be managed? So net working capital is same as working capital, right? If I ask you a calculation of working capital or working capital, is to ask current assets minus current liabilities, just if you need to know that. How should short-term assets be managed? Short-term assets are like your inventory, your products in the business. Yeah, so basically your inventory, I told you, short-term assets, how it must be managed. You have to make sure that it's sold. Make sure you can like do a bank overdraft for buying those inventory and so on, right? Two types of decisions: financial decisions, investment decisions. Financing decisions is how do you get money for your investments. Investment is your investment. So investments are like when you buy a share, If you buy a share, you want returns, right? That's investing. Financing is more of getting money to do your investment. So obviously you need money over here to invest. So how do you get this money, right? From your shares, from your equity, debt, all that, right? To invest. Um, right. Forms of business organization in South Africa. One, two, three, four, five, six. We're learning about six. Firstly, you want to classify these three as different, right? These three as different. Because all of them over here is a bit different, right? But they're very similar, these three. You'll know why just now. Sole proprietorship. Wait 1 second. Sole proprietorship, right? Sole proprietorship. Yeah, I spelled that correct. Sole proprietorship, right, is your first owner, like type of ownership. It's where you own a business, right? And it's a very small business, huh? It's owned by only one person. Very, very, very important. Only by one person. Not two, not three. Only by one person. So if you have a spaza shop only owned by one person, that's a sole proprietorship, right? It has, it's the most common type. Very easy. Very easy. Low cost, very easy to operate. Small business, very easy to operate, right? Advantage. Tax once on personal income. Now, why is this an advantage? If you own a company, right? If you own a company, you're going to pay tax two times. So you're going to pay tax on the company's profits and you're going to pay tax on the investors' profits, so your shareholders. So if you're a shareholder, you're going to pay tax on your profits and the company is going to pay tax. That's a disadvantage. That's double taxation. Sole proprietorship, the business over here does not pay tax. But the person who owns the business, the income from the business only pay tax on the income. See what I mean? The business alone does not pay tax, right? But the income that the person is getting from his own business, tax on that. Very important. So that's a sole proprietorship, right? Very small, owned by one person. Disadvantages. Now, if they ask you an essay on forms of ownership, you want to discuss something called liability, whether it has a limited liability or unlimited liability or continuity, what this means. Liability, if I say it has an unlimited liability, so let's say you invest 5 rand in a company. If that company goes bankrupt, that 5 rand, if it's unlimited liability, the 5 rand is going to be taken away. But all the losses the business make, it needs to get money. So what is it going to do? It's going to come to your house and get your car, come to your house and get your TV, come to your house and get your baby and sell it off. That's unlimited liability. So you're not only losing the 5 rand you invested in the business, you're losing your whole family, man. You're losing your baby. They're going to take your baby and sell it. That's unlimited liability. Limited liability, however, is when you only lose your 5 rand in the business you invested. Done. They're not gonna come and take your baby, all that. No. Limited liability, only lose what you invested. That's good. That's an advantage actually. Now continuity. If a business has continuity, if the owner dies, the business will still be there. That's continuity. No continuity means if a person, like a sole proprietorship, if he dies, there's no continuity. The business can't run. Only one person business, right? Can't run. No continuity if he dies. So continuity, there is no continuity. So you must say that there's no continuity. That's a disadvantage. And liability is not limited. That's another way of saying liability is unlimited, right? There's no growth, right? Very small funds a business has. If you're a sole proprietorship, one person, right? It's very hard to get capital, to get money. So yeah, that's a big problem, yeah? Extremely big problem. Partnership, 2 to 20 people. Right. Advantages, you can get money from all those partners. So if you have 5 people, you can get you can get like 10,000 from each 5 people. That's 50,000. So pooling resources, that's an advantage. Having an agreement. For you to start a partnership, you have to have something called a partnership agreement. This is an advantage. So the one partner can't say, oh, you owe me this, oh, I supposed to have this amount of share in our partnership. No. Partnership agreement stipulates how much each partner has, everything. So the partner can't come here with legal reasons, say, no, I supposed to have this. No. Partnership agreement tells exactly what each partner has in the business. Partners are liable for their debts, unlimited liability. I told you. If the partnership goes bankrupt, the amount of losses the business make, the money to get and pay all those losses can be taken from the partners. So you can go to every single partner in the house and claim their car, claim their house, claim their baby. You can do that. Unlimited liability. So that's a big problem. That is why nobody does partnerships over here. In South Africa, if you have to do a partnerships, you probably have to make 10 babies to cover the cost. They'll come take all the 10 babies away. Even twins too. Twins will be in the court, they'll come and take it away too. Yo. So yeah, that's unlimited liability. Major disadvantage, yo. So disadvantage, there we go, no continuity. Dies the whole, even if one partner dies, there's 20 people, one partner dies, the whole partnership closes down, no continuity. Limitations to the owner's transfer, yeah. You cannot transfer ownership. So another partner wants to be in a partner, it's extremely hard to allow him in. Owner have unlimited liability, I told you. Close cooperation. Now you must know close cooperation can no longer be registered in South Africa, but what close cooperation now in South Africa exists still is allowed to be there. Cannot be created new ones, no. But what's are now here in South Africa can be still here, right? Separate legal entity, what it means it has continuity. It means it has liability, limited liability. So limited liability, there we go. And they don't tell you here, but it has continuity, right? Well, kind of when they say separate legal entity, it means continuity and limited liability, right? So it could last if anyone dies. It could limited liability. You only lose what you invested. Very good. And 10 members, right? 10 people allowed as owners. 1 to 10 people. No audit. No audit is an advantage because auditing is like costly, man. So yeah, so that's close cooperation. Now company. We're going to talk about companies. Companies, there's 2 types of companies. Public or private. Public or private. So let's see the difference here, huh? Come on. Now, why is it not working? Okay, so firstly, the company. So, okay, there we go. The company. So you have a private company and a public company, right? So what's the difference between the two? A public company, so number 1, number 2. A public company over here, right? Major difference is they get shareholders as owners. The ownership in a public company are all the people who bought shares in the company. The ownership in a private company is all the people that are invested in the company. Let's say you have Sam, Tom, and Ben. They get together, open up a business. They're a private company. A public company are companies where the owners are only shareholders. So if you get 1 million people and they own shares of this one company, all of them are owners, right? So major the comparison, yeah. Requirements: private company, think you can do your own things. Private, 1-1, so 1 director, 1 shareholder. Public company, at least 3 directors. You have to have 3 directors, and you have to have at least 7 shareholders, right? Trading of shares: private, you cannot trade shares. Public, you can trade shares. Assets to capital: private company, you can't get a lot of capital, but public company, you can. Why? You can offer shares to the public. You can gather a lot of capital, right? Disclosure: very few disclosures here. Over here, public company, a lot of disclosures, because public companies need to be on a GSC. You need auditing, all that stuff, right? Management and control: private company, right? Private company, there's more control because the owners is the people. Sam, Tom, and Ben are the owners of the private company. They're good. However, public company, you have 1,000 shareholders. Like the only owners are shareholders. So there's no actually people that own the business. People. I mean, yeah, kind of shareholders are people. What I'm trying to say, emphasize to you. Compare 3 of your friends making a business, and compare shareholders, thousands and millions of people who own shares in a company. They're the owners. Do you think those 3,000 people, million people, shareholders will be efficient in controlling the business? No. Right, no. That's why they appoint all directors and all that whatnot. Compliance, very few, big. So all the compliance regulations, private companies not so much. Public company, big regulations, big audits, costly. Valuation. So valuation is more of looking at how much a company is worth. Private company is very hard to determine that because we do not have the financial statements. Public company, they do have financial statements. You can research any public company right now, get their financial statements and whatnot. So yeah, that's public and private company, right? See, this is the way companies work, right? So, for example, public companies where you have shareholders. So let's say this is shareholders. They're going to appoint directors. Directors will appoint CEO, and then CEO manages the whole operation, right? Okay, so these are the advantages of a company. They're not talking about public or private, just any company. They all have limited liability, whether public or private. They have limited liability. They also have continuity, right? They also have continuity. They last forever. Both of them, both companies, private or public. Um, Ability to raise sum of money, large sums of money. That's also advantages for both, right? And also, yeah, they can also have transfer of ownership for the public companies. They can get more capital. Like that's all you need to know. Hey, disadvantages: taxes are extremely high. If you want to be specific, 27%. More expensive to organize, highly regulated disclosure. Think of disadvantage of a company as a big headache. Taxes, disclosures, laws, you need audits, you need all those documents to sign up. Very hard to start, extremely difficult. And this you can just pause the video and watch, right? Or there's what limited, unlimited continuity, but we mentioned all that. Okay, so we're done. Now what's profit maximization, right? Profit maximization, what are the problems? So if you want to increase your profit in the business, so if you look at your income statement, profit after tax at the end, you want to increase that figure, right? Because obviously if you're making more profit in the business, if you show people that, people will like love you. So what is the problem with this? The problem with profit maximization, if all businesses want to do profit maximization, they might lie. They might lie and say that their profit is more than what it actually is, right? They might ignore timing of returns. So in accounting, we do something called the accrual method. So if your profit shows 1,000 rand in your income statement, you might not have the 1,000 rand in cash because that might be money that you received. That might be like money you're supposed to receive but never receive it. You know what I'm saying? So money you're supposed to, yeah. So according to accrual concept, you account for income that you earned and expenses that you incur. So it's not really cash. So although you have a high profit, you might not have a high cash. You see what I mean in your business? There we go. These two are almost the same, right? Also, the timing of returns. They say cash flows are better than profit. Why? Cash is better than profit because cash, you can now take the cash in the business and invest it into something and get returns instead of just profit where cash you don't have cash right now. So just remember, cash to have in a business is better than just having no cash. That's what it's basically saying. Does not incur for the cost of equity capital. Okay. So if you want to either choose to issue equity as capital or debt as capital, if you issue equity as capital, it doesn't incur what is the cost, opportunity cost. So of losing out on debt equity. For example, sometimes it's bad. If you choose equity capital and that's bad, then debt capital will be actually better. So in your financial statement, it doesn't tell you that, listen here, this person over here chose equity capital, but in reality, debt capital was actually a better option. So you'll actually save more money, profit will be high in the business. They don't say that. And overlook risk. If your profit is very high, it might not be a good thing because that might mean you're doing a lot of risk. So yeah, could be very extremely bad. Huh? So higher profit doesn't always mean it's good for the company. Shareholders, what do they like? They desire maximum value. Okay, so if you make more profit in the business, it'll make your share price higher. So that's what shares people like. That's what shareholders love, right? They love that. They love that. Um. So now, so the whole objective of your financial management is making sure your maximize value return is greater than your cost of capital. So your investment, your return. So you bought inventory. That's your investment. You sold inventory. You got 100,000. It must be greater than what you bought the inventory at. For example, 50,000. Sales minus cost of sales. Your net profit is 50,000. This is your happy figure. So obviously this must be greater than this figure. The cost of getting all these goods here must be greater than the cost of getting the goods. You get it, man? Um, Ethics of maximizing value. So to maximizing value means making the shareholders happy. What is the ethics? Ethics means ethics. What is ethics? They are socially acceptable standards. They're things which you should do in life. Good things you should do in life. So what good things you can do in life basically as a business? You can do a lot of good things. You can do donations to communities. You as a company can do CSR, right? So KFC does Two Rand for Hope. Whether that Two Rand for Hope actually goes to Hope, we don't know. But that's a form of ethics of maximizing value. Because when you look at KFC, you like, KFC is high value. They're donating all that. That's what we're trying to say over here. So all this is CSR, corporate social responsibility. They're like all donations to communities, giving back to communities, providing bursaries, providing donations, providing good things to the business where it's in the venue is in. If the business is located next to a rural town, make sure you tar the roads, make sure you do the CSR, community, ethics, right? Um, let's go to the next one. We're almost done. Okay, why is it not working now? Okay, so fundamental concepts in finance, present value. Now, all this we're going to learn now in the after chapters now, right? Not even going to be in this test, but present value is the amount of money you have now. Time value of money means that the money you have now will be different than the money you have later on. For example, 20 Rand in 1900s were like 100,000 Rand back then. You know what I mean? Because of inflation, money is different in different periods. Risk and return, you invest in something, you might get a return. There's also risk involved. Efficiency market hypotheses are extremely important. Okay, before I do efficient market hypothesis, that's extremely important topic. Discuss portfolio theory is basically investing in shares, but a lot of shares instead of just one share. This not an examinable to be covered in semester 2. So what I want to discuss, where's the other one? There we go. What does efficient market hypothesis mean? EMH. Right, let's discuss it. So EMH, efficient market hypothesis. I want you to think of share prices, right? You got a company, they go on the JSE and the share price is 10 Rand. The share price here is affected by a lot of stuff, right? If you get news that this business is doing some stupid stuff, the share price is going to go down. If you are this business and you say that, hey, you know what, you did well this year, you got an income statement profit of 1 billion Rand, your share price will go up. The efficient market hypothesis says that the price of the share is very smart, it's very intelligent, it's very efficient. If something is good, the share price will go up suddenly. If something is bad, it's going to go down suddenly. So you cannot actually profit from it. What do I mean? If you look at the news and see the news that the company made extremely good profits, you know in your head the share price is going to go up. So you're like, oh, let me invest in the share now. So when the price does go up, I profit from it. But you can't do that. Why? If you've seen the news already, it's too late. If you've seen the news already, because remember, as soon as the news comes out within the milliseconds, the share price is going to shoot up. So you're going to miss that opportunity. So when I'm saying markets are efficient, according to this theory, it's basically saying they're very quick to react to situations. This 10 Rand right now is going like in up and down, because it knows what's happening in the world. It's very good. You cannot profit from this because if you know a good thing that's going to happen, the share price already knows about it. And this is how this whole concept of efficient market hypothesis works. Huh? It also says that, you know what, people, they also see, although this efficient market hypothesis says good things, it also says it lacks bad things. The market, they say, can be inefficient. So what it means, so you know how sometimes you see the price of a share goes up suddenly and then just drops. That means it's inefficient. It's inefficient when the share price is not actually a good representative of the company. Because think about it, sometimes the share price goes up so much, but that's like overvaluing the company. That's not actually the share price. That means the market is inefficient. This happens when a lot of people panic sell. So let's say you a business COVID time and you suddenly looking at COVID and you just panic sell. So a lot of people sell their shares. When a lot of people sell their shares, the share price is going to go extremely down fast. So from here, Corona came, boom. Where this point is now is not actually where it should be. This means it's inefficient. The market is inefficient. It's not representing the share price well. So although the efficiency market hypothesis says that it's very good that the markets react quickly, sometimes they can be stupid and does this. That means inefficient. So the whole efficient market hypothesis theory states that yes, markets, the share price reflects well of the surroundings. Also extremely important to do MCQ biasness. The markets are not biased, right? Are not biased. Now, this is MCQ question I saw somewhere. They said markets react to situations, right? In the environment. Your answer will be false. Now I know it's contradicting what I just said right now, but the markets do not react to stuff that's happening. The markets already knows what's already happening. So in case you see that in MCQ, the markets react to stuff that is happening, your answer should be false. It doesn't react to stuff that is happening. The share price knows exactly what's going on in the past and present. It knows. It has no biasness. It doesn't choose what to react in the world. Always remember that, right? So the answer will be no. And yeah, that's it for this video.